My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. In my other videos, I talk generally about dividend investing. So if I go over to my channel here, if you go here on YouTube and you go under my channel, you'll see, I talk mostly about dividend investing, the simple path to wealth with dividend investing. This was inspired by JL Collins. It's really about retiring early or retiring off of your dividend portfolio and not so much off the 4% rule. The second, main topic on my channel is the Review My Pie series, what you're watching today. And I've been creating these Review My Pie videos for 4 years. This week will be the 4th anniversary of this series. So I've been doing this for 4 years. I do this once a month. So if you're a subscriber of the channel, you can look forward to this. Every single month, I do these Review My Pie series. And then the last topic that I talk about on my channel is financial independence. That's really top of my mind right now because my wife and I, we reached what is called barista fire at the age of 37. So we're no longer working our 9-to-5 job. And if you've never heard of barista fire, watch this video right here, the stages of fire, and you'll know what I'm talking about with barista fire. Because I think a lot of people, if you're pursuing fire, this may be an option that is available to you much sooner, much earlier in life than traditional fire where you're working for 20 years or 30 years. You may be able to achieve a balanced approach where you're working part-time like I am and living off of your portfolio. In today's Review My Pie, we're going to take a look at one question and 3 portfolios. The first question is from a 50-year-old here in the US. The first portfolio is a 21-year-old from the US, the second a 35-year-old from Brazil, and then the third a 39-year-old from the United States. As always, everybody, the timestamps will be in the description as well as the portfolio links will be in the description. And as always, everybody, I'm not a financial advisor. Please don't take what I'm saying as financial advice. It's just merely for your entertainment. And I also do not review the portfolios in advance. So when I'm reading these emails and reviewing the portfolios, I'm doing it as I'm recording live. So I don't script anything that I'm going to say. And so I try to keep it as authentic as I possibly can. It always amazes me reading your emails and seeing people when they're 16 or 17 years old and they're already thinking about investing. I think everyone watching this video who's older than, maybe 16, 17, wishes that they started investing earlier in life, and especially when you realize and you're getting older and you need to start adulting, it's not an easy thing to accept. Unfortunately, life doesn't always go to plan, and it could look a little like this.
That might work for Dutch, but for you, it just makes you look stupid.
Come along. See?
But it wasn't my fault.
Worst effects ever.
No, I don't know.
Yeah.
What? No, bro. How was I supposed to know?
Oh my gosh. Oh man. All right, let's take a look at this question here from Todd. He writes, Jake, I found your channel and need some help. I'm 50 years old and just getting started in the investing game. I'm starting out with $1,000 and was just wondering hypothetically, where would you start investing? Meaning which ones would you start with? I'm assuming you're talking about investments, right? Which ones? My wife works full-time and has a good job. I'm a realtor and have some side hustles going. I realize I'm getting late to the game, but I want to reach out. I realize you're not a financial advisor, but you do make a lot of sense and seem to have a great grasp on this stuff. Just looking for some starting advice. Thank you, sir. Well, Todd, thank you so much for reaching out, and I appreciate the kind words. I don't have everything together, but I think, I try to keep a level-headed approach on how I view things. Look at the bright side, right? You didn't say that you're in debt. You didn't go and you didn't break down all your finances. So I don't have all of your information. So it's a little bit difficult to really pinpoint where to focus. But really, when I see that you're 50 years old and you're just starting out, what's screaming at me, anyone who is 50 years old and is just getting started, the most important thing that I always think of whenever I talk to people is where you're investing your money. And so the number one thing that you want to take advantage of is, because in most cases, you are probably, if you're just getting started, you're probably going to retire after the age of 59 and a half would be my assumption. So the very first thing that you want to make sure that you have in place is you have a strategy around your tax advantaged accounts. I'm talking your health savings accounts, your HSAs, I'm talking your Roth IRAs, your traditional IRAs, your 401ks, all of your retirement accounts. And you want to make sure if you're 50 years old and you're understanding, okay, realistically, when am I likely going to reach retirement? If it's after the age of 59 and a half, you're going to want to put all of your effort and energy in maxing out your tax advantaged accounts. That's the number one thing that you want to make sure that you're focusing on, where you're investing the money. And when you say which ones, I'm assuming you're talking about what kind of investments. Now, I'm not Dave Ramsey, and I'm not going to give you some arbitrary thing to go and just go pick the highest growth mutual funds. I'm going to give you some suggestions that may help you get started. The important thing here is when you're thinking about this whole dilemma of you're late to investing, it really comes down to how are you managing your money? What is coming in and what is going out? How are you managing your expenses? Is more money going out than is coming in? Are you able to invest money? Are you budgeting? You sound like someone who really needs to get back to the basics and understand budgeting 101. How are you budgeting your money? Are you budgeting? Are you putting money aside? Are you, paying yourself first by investing first and all of that stuff? So you want to make sure that that is top of mind for you. Because I promise you, Todd, if you don't have the foundation, the basics in place, no one ETF or stock pick is going to change your situation. Okay. So that is the number one thing. If I can knock some sense into you, that's the number one thing. You want to get your stuff together is understanding how are you spending your money? How are you budgeting? What are your goals around investing? I love the example with real estate. You're a realtor, right? When you think about real estate, you have two options when it comes to investing. You have those that are house flippers that want to come in, buy the house low, and then flip it and sell it for a gain. That is one form of investing. That would be related to kind of like the 4% rule. On the other hand, you have real estate investors who want to buy rental properties and they don't want to sell their properties. That could be perceived or seen as a dividend stock or a dividend ETF, where you're holding the asset and you're living off of the passive income. Okay, so as a realtor, I think you can wrap your head around the concept of buying low, selling high, versus the investment strategy of investing into a buy and hold strategy like a dividend growth strategy. So when it comes to the investing part, I would recommend looking at investments that you understand first and foremost, because you're new to this. Investing is incredibly emotional, and if you're just starting out and you're late to the game, you want to make sure that you can make it tangible and it's something that you can understand. And so when you go and you read blogs or articles or comments or watch videos on how to invest, you first need to understand what your goals are. And once you have your goals and your investment time horizon, then you can kind of work backwards and say, okay, are you going to realistically retire at the age of 60 or 65 or 70? Because your investments, they're just vehicles. And right now you're just trying to understand, well, which vehicle is going to get you to where you're trying to go. And so somewhere where I really like to start is I really like looking at ETFs like SCHD and DJRO. In your case, because you're a little bit closer to traditional retirement age, I would skew more into SCHD, a lower amount into DJRO. But it's important to have DJRO in there because you're going to get more growth on the tail end. Because you could live another 30 years, you still want to make sure that your portfolio is growing. That's how I would approach this. I would look at investments that have a good, healthy dividend yield, like SCHD. You could look at VYM, for example, and really just focusing on getting your habits right and dollar cost average, really focusing on the basics. And once you've done that, then you can take the next step and try to understand how you can kind of engineer the next phases of getting yourself ready to live off of your investment portfolio. But right now, it sounds like you really got to focus, not to quote Dave Ramsey, but you really got to focus on the baby steps and make sure you got that in place first. And then one last thing when it comes to that, I would highly recommend to stay away from individual stocks. I would focus on low fee index funds, focus on index funds that have really low fees like SHD, VYM, DGRO, and understand and research how to invest based off of your investment time horizon and truly understand what your goals are and then work backwards. So Todd, I hope that that's helpful. Anyone that's in, a similar situation as Todd, whether you're 50 years old or 20 years old, it's first understanding and putting the basics in place and not thinking that you're going to pick the right stock and you're going to make it to the moon and then all your problems will go away. There's no wonder why all of these professional athletes go bankrupt after they make their millions and millions of dollars, because they don't change their habits. You got to focus on your habits and you got to get the foundation set up first. Thanks for sending over the question, Todd. I appreciate it. All right, let's take a look at the first portfolio here from Nick. He writes, "Hello, Jake. My name is Nick, 21, living in the US. My goals at first were to use a higher yielding ETF, PI, around an 8% to build a portfolio I could live off of as fast as possible. After watching more videos about growth investing, I wanted to reconsider my approach. This is a portfolio I made using some of the top names of each industry. Any tips or changes you think I could make to improve upon a portfolio like this? Thank you for reading." Well, Nick, thank you so much for sending over your portfolio. I'm glad that you're reconsidering that approach, because unless you have hundreds of thousands or, $1 million already set aside at the age of 21, I don't think that that approach is going to be right for you or for 99% of the people watching this video. Simply, what it boils down to is understanding total returns and how your investments are growing. If you're 21 years old and you get into an investment that is growing at 8%, and let's say it stagnates at 8%, well, what's going to happen in 20 years? Are you going to have to go back to work? Because that 8% is going to get dwindled away in most cases, because the investments are probably going to have a return of capital. They're probably not going to increase their dividends, and they may even cut the dividends because you're reaching for yield. What happens then? A lot of people, they get sucked into this fantasy of, higher yield equals better. It's not the case, my friend. It doesn't work that way, not in all cases. And that's why it is so important that you understand how to invest based off of your investment time horizon. All right, let's take a look at your portfolio here. Let's see here. So you got 24 holdings. That's not bad. That's a pretty good amount, actually. You got a good, decent dividend yield, and you have a very low expense ratio. So what do you have in here? And I think you set this portfolio a little while back. So let's see here. So you got SHD in here, and you have a handful of different stocks. Okay, cool. So at face value here, I actually kind of like this approach. It's similar to mine, but I think we can do a little bit of tweaking, and I'm not trying to tell you what to think, I'm trying to tell you how to think. Okay, so I want you to think about this in terms of time commitment. Do you really want to follow up on these companies? Do you want to, keep track of how AT&T is doing? Lockheed Martin, Duke Energy. Do you want to follow up on these companies, or do you not? How passive do you want to make this? So that's something that you definitely want to consider. Though I will say, by pretty much equally weighting all of your holdings, it does make it a lot more passive, which I think is a good thing. This kind of follows a little bit the simple path to wealth with dividend investing using the core and satellite. But I think what I would recommend, especially if you're new to this, if you're new to investing, I would skew much, much heavier into ETFs. And if you don't understand the core and satellite, watch that video on my channel around the core and satellite. But I would recommend bumping up your core, which is made up of low fee index funds. And for me, the simple path to wealth with dividend investing is you have SCHD and DGRO as your core, and your weighting allocation is dependent on your time horizon. For example, with Todd, the guy before, he would have much higher weighting into SHD and much lower into DGRO. Now with you, because you're so young, I would recommend the opposite, right? Where you skew maybe a little bit more into DGRO. And that's understanding your time horizon and how to invest based off of your time horizon. In my opinion, I probably, if you were sitting next to me, I'd say, hey, take a look at this, see if you can put in some more ETFs in here to cushion your portfolio, maybe 60 to 80% allocated to ETFs. Yes, you heard me right, 60 to 80% of your portfolio into SHD, DGRO as an example, then the remaining you would reduce the remaining holdings. And, you probably, when you were putting together this portfolio, you probably thought, okay, I need to have some in consumers. I need to have some in, manufacturing, some into telecom, some into staples, some into real estate, energy. When you invest in the simple path to wealth with dividend investing that I talk about, you don't need to care as much about perfect industry specific target allocation or weighting in different industries. You know why? Because you're already getting that in these ETFs. In these ETFs like SCHD and DGRO, you're already getting great industry exposure to all different industries. That's really so much easier and so much more passive than trying to build an index yourself. Now, if you're a hardcore nerd and you definitely want to do this, go for it. That's absolutely fine. But for the overwhelming majority of people watching, I don't think that that's the right approach for most people. So don't fall trap to the idea that you need to have perfect allocation across all industries. If you follow the simple path to wealth with dividend investing, you don't have to do that. If your core holdings are index funds, you don't have to have exposure to every single industry. Okay. So for example, that's why I don't have any individual energy stocks. I get energy through my allocation in VYM as an example. If energy does well, okay, great. It'll be represented higher in my index in VYM, and I get to benefit. And let's say on the reverse there, let's say the energy really goes down and underperforms. Well, it will be represented less in the index. It's the survival of the fittest, right? It's market cap weighted. And I don't have any single stock risk. Okay. So if you're new to this, if you're everyone, guys, read up on this, understand the simple path to wealth with dividend investing. The overwhelming majority of you would benefit from that. However, if you are gung-ho on picking individual dividend stocks and you want to manage it yourself, I think this is a great conservative approach. But I'm just saying for the majority of you watching, it's probably not the right approach for most of you. So Nick, thank you so much for sending over your portfolio. All right, the next portfolio is from Matthias. Hi, Jake. My name is Matthias. In your language, you would say it or speak it as Matthew. And I am from Brazil. Hi, Matthew. I follow your channel and thank you for your help for us who seek financial freedom. Sorry if there are any spelling mistakes. I'm using a translator. No worries, man. You're good. Well, I'm 35 years old and I have a goal of having 25% of my portfolio in American companies through ETFs. It's difficult for me to evaluate the American market, as you probably know, but I try and understand it in general. So ETFs are the salvation. That is for sure. My focus is on dividends. I choose dividend growth ETFs based on your help, but with a little growth as I plan to retire in 25 years. So let's go. I have, and this is just 25% of your portfolio. So I'm assuming the other 75% are in, your local, Brazilian stocks or other companies or maybe European. So this portion is just 25% of your overall portfolio. So you got VOO, QQQ, SHD, DGRO, and VYM. If I'm not wrong, my yield is approximately 2.23% and the expense ratio of 0.09%. Currently, I can contribute $100 per month, but soon I will be able to double this contribution. I made this division because it is easier for me to manage my portfolio nowadays. I'm a military police officer in my country, and I'm studying at the Military Academy for career advancement, and I don't have much time to keep track of my portfolio. That's kind of what I was saying with the other guy. Do you think I'm on the right path, or do you have anything to advise me? Thank you for your help and good health and happiness to you and your family. Hugs from Brazil. Well, hey man, Matthew, thank you so much for the message, for the email. And your strategy is rock solid. I mean, you're 35 years old. You're planning to retire probably at more of a traditional age. I don't know how the tax, the accounts work in Brazil if you have tax sheltered accounts like we do here in the US. But I think focusing just on ETFs is never a bad idea. You could invest into individual stocks like a Starbucks or a McDonald's, have a small percentage if you're a fan of them, if you have them in Brazil, if it's more of an emotional tie. But just, speak just generally, I think this is a good approach. But it's important to understand all 5 of these ETFs have different use cases, meaning there's different reasons or reasons why you would have these ETFs in your portfolio. And I'm going to break them down pretty generically. So the first 2 with VOO, this is the S&P 500 index. This is the largest 500 companies in America. And then you have the QQQ, this is the NASDAQ 100 index. These 2 ETFs are very much focused on growth and total returns. There's no bias or skewing towards dividends. And so the goal is not to focus on the dividend from this investment, but rather the total return, the total appreciation of the investment, the appreciation of the share price and the appreciation of the dividend. Okay. And in most cases, what you're going to do in 25 years, you would look to rebalance these 2 ETFs. You would rebalance them, for example, into SCHD and VYM, or you would buy a house, or you would use the money somewhere else, maybe buy a rental property or whatever it is. But it's important to understand these right here. And this is for everyone, whether you're in Brazil or anywhere. When you're investing into an ETF that is focused on total returns, the goal here is to buy it, hold it, and then in the future, rebalance it somewhere else. Whereas with these 3, these ETFs, these are more dividend skewed and focused on the dividend income and the dividend growth. The focus here is not to buy, hold, sell, and then rebalance somewhere else. The focus here is very simple. It's buy, hold, and hold forever, and just live off of the income. And this is why dividend investing is so appealing. It takes away the timing and the emotional aspect of, well, in the future, I'm going to have to rebalance. With this strategy here, with 60% SHD, DJRO, and VYM, it's very much set it and forget it. In 25 years, you are going to live off of the income from these. Okay, in 25 years, you're going to sell these and reallocate the money somewhere else based off of where you're at in life. Okay, and so they're very different strategies. And something that you want to consider as you get closer to retirement, so you're 35, so once you get closer to 60 years old, you can then slowly look to reallocate how the weighting is set up in your portfolio. So the new money that you're putting into the portfolio, you can then look to adjust the weighting. Okay. This is not something that you're going to go and, change on a daily, a monthly basis. This percentage here is something that you would update and change maybe on a yearly basis or biannually, right? Like not something that you do very, very regularly. So very, very much a set it and forget it. So Matthew, those are the main points that I wanted to get across. And then once you have that foundation, that understanding, then it just becomes a question of math. Well, how much money do you have to invest over what period of time to reach your goal of your desired income, your dividend income? And this is greatly dependent on how much you're investing, what you're investing in, and your expected or anticipated expenses in the future. So those are the things to consider. I hope that this was helpful. I think you're on the right track. I think you really are focusing on the right things, and these are high quality ETFs. Just remember, this is not a portfolio that you're going to rebalance on a regular basis. It's very much a set it and forget it. So Matthew, thank you so much for sending over your portfolio. All right, the last portfolio is from Ilya. He writes here, "Hi Jake, hope all is well. Really enjoying your content on YouTube. I was hoping to get some guidance on how to structure my portfolio for dividend income in the future. I like to live off of my dividend income in about 5 years. Here's what I have so far." And I also got an email from you that you're 39 years old. So putting that into context here. So you're 39. All right, so let's take a look at this. You got 190K in your 401k divided into a Roth and a traditional. You're 100% into VIGAX. This is the Vanguard Growth Index. And you got 135K in a taxable brokerage M1, 100% into VOO. Okay. And you got 10K in a Roth IRA. I do some swing trading there. I plan on adding about $800K in various forms of lump sums and dollar cost averaging over the next 5 years. I like to structure my portfolio in the core and satellite method, just not sure how to proceed going forward to get the maximum amount of growth. I'd love to know how you would handle this if this was you. Thank you, Ilya. So, well, it sounds like you're in a really, really great spot here, Ilya. So you're 39 years old. So at about the age of 44, in your mid 40s, you're looking to dial back and no longer work a full-time job. Have you considered, going part-time or doing something like Barista Fire? Or are you planning on just full-blown, hey, I'm never going to work another day in my life? That's maybe something that you may want to consider. 44, you're really young. You don't mention if you have a family, if you have kids. What are you going to do in that time? What are you going to do with your time? So that's something that I would also think about. You don't write that here in your email, but it's something that you should think about. Well, let me take a look at the first one here. So you have the money divided into a Roth and a traditional 401k. The very first thing that I would do is I would have a plan around this. Something that I did, is after, I quit my job, I took everything from my 401k and I rolled it and converted it into my Roth IRA. Now, some of you are not going to understand what I just said. So you have a 401k that is a Roth 401k. What you can do is what is called a rollover. You will not pay any taxes on a rollover. However, if you have a traditional 401k and you convert it to a Roth IRA, you will pay taxes in the year that you convert it. But that is something that I would definitely consider for you. You have such a long time before you reach retirement. I would put together a plan once you stop working and you're in a lower tax bracket, put together a plan of how you can maybe each year over, 3 or 4 years, how you can convert the traditional portion of your 401k into your Roth IRA. And so you can effectively pay zero taxes for the rest of your life. Okay, something to think about. The next thing here is you have 135K in a taxable brokerage account. So what is your plan here? So effectively what you're going to have is you're going to have 135,000 plus 800,000. So you'll have about $900,000 in a taxable account. What I would recommend is, looking at, SHD and DGRO. And if you're looking at the simple path to wealth, I would look at what percentage breakdown you want to have into those two ETFs. Because you're going to be 44 years old, you 100% want to have a combination of both. You don't want to just have SHD or just DGRO. You want to have a combination of both because they go better together. You're going to get more growth and you're going to get more market participation by having both of them together. And so what I would recommend is look at what your target income is. So for example, if you need 80,000 a year, 50,000 a year, 100,000 a year, 45,000, like whatever your income target is, make sure that you're focused on that. But as well as you're focused on the income, you want to look at the weighted average dividend growth rate. So how much is your portfolio going to grow year over year? Is it going to outpace inflation? So you don't want to just go 100% into cover call ETFs as an example, or 100% into REITs. Like, you want to look at this with a core and satellite. You look at it as an overall, as a holistic, from a holistic approach of your overall portfolio and your overall yield and overall dividend growth. Don't just look at one individual investment. That's incredibly important. And I would focus, depending on you and your goals and how much time you want to spend on this, 60 to 80% into your core holdings like SHD and DGRO. And then you could throw in a cover call ETF like JEPQ. You could actually now start dollar cost averaging into JEPQ. Because you're within 5 years of living off of your portfolio, you're a perfect candidate to start slowly adding JEPQ to your portfolio if you want to boost the income. You could always add it later or after, you lump sum in 5 years, however you want to do that so you can optimize for taxes. But that's something you definitely want to have in your mind, as well as how you can optimize this for taxes over the next 5 years. Because if you go all in now on a high dividend while you're still working, you're going to have a pretty high tax bill, especially if you're going into these cover call ETFs because they're taxed at a non-qualified rate. In fact, let me tell you what I would recommend. So in this video right here, why I chose dividend investing versus the 4% rule, towards the very end of the video, I talk about what I would do differently if I could start over. I would recommend watching this video right here. I made it, just last 2 weeks ago, and you'll see some thoughts that I have around just starting out. But yeah, in that video, I mostly talk about starting out a little bit slow. Don't go and add 50 different companies to your portfolio. Maybe start out with maybe 10. You do, SHD, DJRO as an example, if you want to follow the simple path to wealth with dividend investing, and then you pick a handful of individual stocks or other ETFs that will help you reach your goal, your income goals, your dividend income goals. If you need more yield, you go look for VYM and JEPQ. If you need more growth, go look at Lowe's and Home Depot as an example, or PepsiCo. Like that's how you should look at that and balance it out, and while still focusing on the core and satellite. The last thing that I'll say here is I think you have a missed opportunity here with your Roth IRA. This is probably your most important account next to an HSA. If you don't have an HSA, definitely look at that. You want to consider that as well. But this is by far your most important account that you have here is your Roth IRA. And I think this is a lost opportunity by swing trading in here. What if you have losses? You can't take the losses in a tax advantage account. I'd highly encourage you, if you're going to swing trade and play, go open up a Robinhood account or whatever account and do it there. So if you have losses, you can write off the losses. Your Roth IRA, man, you're going to be retiring at 44. Your retirement accounts are going to be able to grow for the next, 15 years? Do you really want to swing trade in your retirement accounts? Especially when if and when, I would hope when you roll over and convert your 401k into your Roth IRA. You want to ideally set this up on autopilot and just let this compound in the background and don't even touch it. That would be my recommendation there. And really just put this account on Coast Fire, where it's just compounding in the background. Okay, I've talked a lot about that, how my wife and I did that, but it sounds like this is a missed opportunity if you don't take advantage of your Roth IRA. So that's something that I would highly recommend that you reconsider and look at this a little bit more strategically than just swing trading. Well, Ilya, thank you so much for sending over your portfolio here. One thing that you'll notice as you get closer to retirement, as you're making more money, taxes become a bigger and bigger topic that you really have to address. And so you want to make sure that you're looking at this from multiple angles. You might look at this that 5 years is an eternity away, but I will tell you from personal experience that the days are long, but the years are short. When you look back on all that you've accomplished over these next 5 years, you want to make sure that you're happy and you're proud of where you're at, and that whole enjoy the journey, because it's not always just about the destination, it's also about the journey. Thanks again, Ilya, for sending over your portfolio. Well, everybody, thank you so much for watching. I hope that the video was helpful. I really try to focus on helping people try to understand how to think versus what to think. By doing so, I think you're going to get a lot more value. I don't have anything to sell you. I don't have a Patreon, but if you do want to support my channel, you can check out some of the affiliate links that I have in the description of this video and in the pinned comment. For example, Seeking Alpha is running a promotion this week that ends on April 3rd. You'll get 25% off Seeking Alpha Premium by using my link. But yeah, thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.